In the meantime, and this kind of gets back to the whole higher yields conversation, what we're seeing in the Treasury market with a huge wave of issuance, bank stocks getting hit hard in today's sell-off as higher rates put pressure on that sector. Let's bring in RBC head of U.S. bank equity strategy, Gerard Cassidy. Gerard, it's great to have you on. We've been talking about the KRE, which broke below $40 in trading today. Certainly a lot of weakness inflicted by investors on the regional banks, but we are seeing some cracks in some of the bigger names too. I guess just walk me through why the concerns and how prolonged they could be, especially as we await earnings season.
Morgan, I think what we're seeing with the bank stocks is that with the rise in the long end of the curve being so rapid and now high, it's weighing on bank stock investors, particularly when it comes to the unrealized bond losses that these banks have in their available for sale portfolios. The largest banks have to take those unrealized losses through their regulatory capital in addition to their GAAP capital, or the capital you see in their 10Qs and 10Ks. The regional banks do that through the 10Ks and 10Qs, but not through regulatory capital. The concern might be, though, that the new Basel III endgame regulations that are proposed and are likely to be finalized next summer with implementation beginning in middle of 25, that's going to require more of the regional banks to include that in their regulatory capital, the unrealized losses. But we have to remember, the bond losses will burn off. These are not credit losses. These are duration issues. And over time, the bonds pay off and they will come back into capital. But that's what I think is weighing on all the banks right now.
Yeah, I mean, but this unrealized bond losses, I mean, this is so key because this is what triggered quite literally a run on the bank for SVB. And of course, we've seen this in the era of mobile technology and people being able to make their transfers so quickly, so rapidly. So when we talk about unrealized losses, which investors are clearly very focused on right now, who has the most? Who should investors be steering clear of? Where is the pain overdone?
I think it's overdone for all the banks, to be frank. You look at where they're trading relative to book value at today's close. The top 20 banks are averaging around 80 to 85% of book. And remember, book value includes the unrealized bond losses. So we're trading at valuations that we haven't seen even during the financial crisis in terms on a relative basis, relative to the market. And so what's interesting is, you brought up the Silicon Valley situation, which of course was disastrous. But we have to remember that was a really episodic one-off event because 95% of their deposits at Silicon Valley were not insured. Nobody, not a single bank is even close to that today. So there's no funding issues at the banks. So it's really, you got to ride it out. Now it's painful. Don't get me wrong. This is not fun, but there's no risk of funding losses or funding crisis or anything like that. But you do have to ride it out. But the stocks are cheap. A Fifth Third, super cheap, very well run. PNC, very strong, another good name. But these rising rates do, worry investors. I understand that.
Yeah, I mean, the KRE, Gerard, is under 40 right now, which I mean, that's the levels where it was near the worst of this. So how will we know that enough of these banks are healthy? I mean, we've been talking about the possibility or likelihood of consolidation within the regional banks. The rates are high right now, which is going to put pressure on those that have a lot of commercial real estate in their portfolios. But, from the reaction in the KRE, it seems like somebody thinks some sort of disaster is coming. When will we know that it's not?
Yeah, it's a very good question. And when you take a look at it, we're testing those May lows. Fortunately, we haven't violated them yet, to your point, with the KRE and other bank indices. And what's interesting is it's really all about the economy and the health of the economy. And fortunately, it's very healthy. And to your point, what's happened in our view, when we talk to institutional investors, when we turn back the clock to March, that was a shocking event. When you think about it, on March 6th, the beginning of that week, Silicon Valley was a healthy bank. And by Friday, it was out of business. shocking. Never seen that before. So the long-only investors have a lot of scar tissue. They're very reluctant to jump into the banks, especially with rates going higher. So to your point, that there's a buyer's strike, if you will, in the long-only community. But at these valuations, if you don't think the U.S. economy is going into a hard landing in 24 on a recession, these are the opportunities you got to find to be able to pick off names that are very attractively priced. But I do, we have to recognize this long end of the yield curve has got people frightened in how quickly it's moving.